I disagree that the current market action or the appreciation of bond value over the past 2-3 years was a function of lack of supply. No, that's not true. In fact, the market is well expecting abundant supply of long-dated bonds coming out of China Treasury going forward in the many years to come as well. I think in the past few years, the market was primarily driven by demand, and that's excessive demand, and that is a function of a voting mechanism. Basically, the retail investors will not be able to drive yield curve. It's primarily the domestic institutions, and those institutional investors are casting a vote of confidence. They basically are saying, you know what, I'm of the high conviction that the growth rate will trend lower, and it will stay low for a very, very long period of time. I don't know where to invest my money, but I want to lock in the high yield, particularly on the long-dated front. So all these small institutions are rushing into the market to buy the long-dated China Treasury in order to lock in that rate. And we see the yield curve itself has flattened significantly over the past 3 years, particularly on the long end. It has come down by almost 2 percentage points over a period of 3 years.
Yeah, that probably explains why the PBOC has reportedly had a word to some of these fund managers and the banks as well, which we know have also been snapping up these bonds and, you know, have a lot of appetite for this market, given the sort of economic uncertainty, as you pointed out. And I'm wondering what this now means as far as the PBOC's other commentary via the financial news outlet about avoiding overinterpretation of moderately loose monetary policy in China. I mean, they sent a very clear signal to the market a few weeks ago from that Politburo meeting with sort of the tweaks to the lingo, as I mentioned, which we haven't sort of seen since post the GFC. But now they seem to be sort of signaling to the market, okay, don't read into this too much. What do you think they mean by this?
I don't think it is an action out of panic or fear. The market is gradually getting used to this, getting used to the central bank as well as other policymakers trying to do the lip service and trying to, I wouldn't call it manipulate the market, but adjust the market to their favor. Those signaling will have a temporary effect, as I mentioned. I think ultimately the market is still looking at the fundamentals. They're making their own decisions based on the long-term fundamentals. And by long-term, I'm talking 20, 30 years. For many of these Chinese institutions, Japan was a good example, right? So yes, in the very short term, the market can move up and down. The yields can go up by 10 bips, go down by 10 bips, or more. But what they are looking at is really allocation of their capital for the longer term. And when I say their capital, it's a large amount of capital. And they have to make sure that they make the right long-term call. And therefore, these comments coming out of either Treasury or the central bank will only affect the market sentiment in the very, very short term, but that will not have a material impact on how these large money, large capital are going to go.